Hi, and welcome to Chapter 8, Portfolio Selection and Asset Allocation. In Chapter 8, I consider this to be a follow-up to Chapter 7. Chapter 7, we established the basics of the Markowitz portfolio theory in terms of risk and expected returns of a portfolio. In Chapter 8, we're going to conclude this discussion by analyzing the efficient frontier, global diversification considerations, and asset allocation considerations. This organizational structure allows you to concentrate on related ideas together and does not overwhelm them all at once with the complete details of this important material, because the basic details of the Markowitz analysis was covered in Chapter 7. So it helps Chapter 8. If you haven't read Chapter 7 yet or watched that video, you should watch that first, because that will help you with Chapter 8, which is going to begin with a discussion of the steps involved in building a portfolio of financial assets. The first step is to use the Markowitz portfolio selection model to choose an efficient portfolio. And the efficient set of portfolios is explained in detail, including the necessary information about different curves. So when I discuss this, I'm going to conclude with showing the matching of indifference curves, preferences, and the efficient set, the possibilities, and these important points about the Markowitz analysis, which can cause confusion when explained if you haven't already gone through Chapter 7. So this discussion that today is going to include analysis of selecting optimal assets rather than individual assets or individual stocks with the Markowitz model. So this topic is considered in detail because it is a good illustration of the usefulness of the Markowitz analysis. With relatively few assets as opposed to individual stocks, the Markowitz model can be implemented relatively easy. So when I just talk about this chapter, I'm going to talk about the long-term performance of a wide variety of asset classes, along with the correlation of each asset class with the U.S. equities. So the information is going to be the basis to motivate you to think about diversification potential, expected return, total risk of various assets, and these considerations are crucial in portfolio management and are worthy of discussion here. I'm also going to include some elements from Chapter 9 that have been touched upon in other chapters, the capital asset pricing model and beta, because that's going to be important for your stock analysis papers. Okay, so the objectives here is, this is to supplement the portfolio theory we talked about in Chapter 7 and utilizing the details of the Markowitz portfolio theory more lively in Chapter 8. So we're going to outline and describe the steps involved in building an efficient portfolio. I'm going to present the concept of asset allocation, and I'm going to talk about total risk, how it can be broken down to two components of risk. Okay, so let's move on to the second slide. So building a portfolio. Everybody in this class already understands what a portfolio is. It's a group of assets. So for a portfolio to be very functional as an investment, diversification is the key to risk management of your returns. So a portfolio, if properly executed and assembled, will reduce or has a possibility to reduce a great amount of risk, thereby stabilizing returns over a longer period of time. So it's one of the most important decisions you'll make in crafting your retirement or crafting a portfolio of assets for a greater return with lower risk. So the Markowitz principles, we got two steps here that we're going to talk about. Step 1, identify optimal risk-return combinations using the Markowitz analysis. So our inputs are going to be expected returns, variances, and covariances, which we learned in Chapter 7. And then 2, choose the final portfolio based on your preferences for return relative to the risks you're willing to assume. So in portfolio theory, a big part of that is thinking about optimal diversification, which is going to take into account all available information that you can assemble. So the assumptions in portfolio theory is that a single investment period we consider that 1 year. Liquid position with no transaction costs, meaning that like stocks, you can buy and sell them pretty easily. We're not talking about real estate here, buying a house or selling a house. And preferences based on portfolio's risks in relationship to the expected returns. So let's talk about a statistical model representation called the efficient frontier. So this is going to be a graphical representation of all of the mean variance efficient optimal portfolios. So we're going to sort of graph all the potential combinations of portfolios, putting them on a graph that's going to look at risk and return as the two axes. Now, portfolios in the efficient frontier, which we'll see in a minute, are going to dominate the other portfolios assembled. So they're really, when we say efficient frontier, this portfolio is going to have the maximum return for the minimum risks. So no portfolio in the efficient frontier dominates another portfolio on the frontier, only other portfolios behind the frontier. So here's a little look at, okay, so we have points A, B, and C. All these little circles here are different portfolios. So now we have ER as the expected return, and risk is going to be measured by a standard deviation. So the efficient frontier would be this curved line between points A and B. So if there was a portfolio right here, that portfolio would have the highest return for the least amount of risk. So any of the portfolios who are living on this efficient frontier would be efficient, meaning that the amount of risk in relationship to the return is the best you're going to get in that particular position. So the global minimum variance portfolio would be represented by point A. So this would be the portfolio that's going to maximize return and risk. So lowest risk with the highest return. So portfolios in A and B on this A and B curve are going to dominate all the portfolios behind the curve. So again, it's just a graphical representation. So if you were to put 15 or 20 portfolios together and then you estimate the risk like we saw in chapter 7 using standard deviation and the expected returns, then you can kind of see which portfolios would be a better mix than others. Okay, so you selecting an optimal portfolio of risky assets. So now the Markowitz analysis will help to create portfolio weights. And so those are a natural output of the Markowitz analysis. So we have to assume here that investors are risk adverse. So that's what an investor should be. They should be risk adverse. So we're going to assume that common sense logic is going to hold in this example. So the indifference curves, the ICs, determine the individual's optimal portfolio. So we can create a set of these indifference curves. So the IC is going to describe the preferences for risk and return. It's going to reflect the portfolio combinations that are equally desirable, and it's going to match the investor's preferences with portfolio possibilities. So this is sort of an offshoot. So here we have the graphical representation. So think of this as the efficient frontier here before like points A to B. So we have these various indifference curves. So investor 1 and investor 2. So where the indifference curves intersect with the efficient frontier, that would achieve the highest amount of return for the lowest amount of risk. So these indifference curves would be something tailored to an investor. So it's just another way of graphically intertwining investor preferences with efficient frontier portfolios. So optimal, how do you select optimal portfolio of risky assets? So we have international diversification, where in the past it didn't offer as much risk reduction as it does now. Because in the past, U.S. stocks dominated for so many years, from say 1945 to the year 2000, U.S. stocks really dominated. So international diversification didn't really help many portfolios as much. Now that the world is catching up to American stocks, international diversification is much more beneficial in portfolios. Now, in the Markowitz portfolio selection model, you have to assume that investors only use risk and return to decide. So that's the only two factors they're going to think about is the risks and the returns. So we're going to boil it down to those two characteristics. So also the selection model is going to generate a set of equally good portfolios, and it does not address the issues of borrowing money or risk-free assets. So we're not going to think about borrowing money and interest rates and risks of paying money back or risk-free assets. And it can be cumbersome to apply to individual stocks. So that's why we like to apply it to asset classes. Now, so the best way to use the Markowitz model, because of the complexity of the model, is to apply it through asset classes and not to apply it in individual stocks. So an asset class would be like bonds, stocks, treasuries, real estate, rather than individual securities. So it can be used also when investing internationally. So you can say international stocks as an investment class. So different classes are going to offer, of course, different levels of risk, different levels of return, different covariances and different reactions to world events. So the correlation coefficients can be quite low between these different assets, which is going to help reduce risk overall. Now, as far as two dimensions of asset allocation, diversifying, of course, across asset classes, and then diversifying within asset classes. So let's think. So diversifying within an asset class basically means if you're going to choose stocks, don't choose all stocks in technology. You want to diversify within the stocks. Bonds, you want to diversify between municipals, U.S. government, corporate. So diversifying across asset classes is including bonds, stocks, gold, which can be called precious metals, real estate. So asset classes, of course, include equities, both foreign and domestic, bonds, foreign, domestic, and government, treasury, inflation protection securities known as TIPS. These are basically will guarantee protection against inflation, and possibly alternative assets such as real estate, commodities, private equity, hedge funds, Bitcoin. These can all be thought of as alternative types of assets. So these are tools or building blocks to build portfolios. Now, you want to look at, we learned in the last chapter, correlation. So you want to look at the correlation between asset classes. So we have to consider how often do stocks move in the same pattern as bonds, and how often does gold move in the same pattern as stocks or bonds. So this correlation, of course, changes over time, but for investors, the allocations, of course, can depend on your time horizon and your risk tolerances. If you're very young, if you're in your 20s, you have a higher risk tolerance and a longer time horizon. So that could mean a more aggressive asset allocation. If you are an older investor with a shorter time horizon, you're going to have naturally lower risk tolerance. So you're going to build a portfolio with less inherent risks, which will also have less return. But you're willing to accept less return in exchange for having the less risk. Because the idea is you're going to be retiring soon and you don't want to come up against the risk of losing half your portfolio during an economic crisis, like we had in 2020, like we had in 2008, 2000, 2002, 1997, and 1987, and so forth. And of course, 1929, just to name a few. Now, let's talk about commodity funds. So commodities such as precious metals, gold and silver, industrial metals like copper, aluminum, livestock. You can invest in pork bellies, grains, oats, wheat, oil products, mostly just crude oil. So these can be built, these commodities can be incorporated to give different aspects of allocation and lowering overall risk profiles. Some of these funds, you could have a bullion fund that's going to hold physical assets like gold, synthetic, which could use derivative securities. So a synthetic commodities fund isn't going to actually hold the physical assets, but it'll hold this synthetic contract that's going to represent the value of the assets. And equities, which are different equities which are going to hold stocks of firms that engage in the business. So for example, if it was gold, it could be a group of gold miners. So this is a way to build commodity funds or even commodities within an asset allocation. Now, easy ways to have an asset allocation without really spending too much money to build the allocation is just buy a mutual fund based on an index, or an ETF with an exchange traded fund, or an ETN, which is very similar to an exchange traded fund. So these are going to cover. You can get these indexes or ETFs in such a wide, large variety of different, and they will cover. There's probably a mutual fund that can cover, and an ETF that will cover any asset class, domestic or foreign stocks, and all different investment styles. So you can have mutual funds or ETFs that are going to be covered different sectors: technology, healthcare, industrial, or that will cover indexes. Different indexes will be mimicked by mutual fund or ETF. Any type of investment style: growth, value, hybrid, and alternative assets. You can get mutual funds or ETFs in real estate, commodities, bonds. They can even group these type of mutual funds or ETFs based on indexes into life cycles. So you can get a life cycle funds that are going to vary the asset allocation as you age through time. So if you're 22 and you buy a life cycle fund that's going to have you retire in 50 years, and you hold that fund for 50 years, as you get older, the mix of that fund will change to a more safe, from a risky to a more safer allocation as you're getting older. So it leaves you virtually, you buy that one fund and have to do nothing. There's nothing you have to do. They'll take care of everything for you. One exception, though, that you have to think about is that these life cycle funds charge higher management fees because they're doing more work for you. So that could really steal a lot of return. Some of these can charge anywhere from 25 to 50 basis points, even 100 basis points. So instead of getting a 10% return, you only get a 9% return because of these excessive fees in some of these funds. So that's something to look out for. And there's really no one correct approach to allocation. Again, it's tailored to your risks and your return preferences. Now, let's talk about risk. Risk can be broken down into two categories: systematic or unsystematic. Sometimes systematic is referred to as non-diversifiable risk, and unsystematic is referred to as diversifiable risk. So the variance, or the risk of a profile as a portfolio, as we measure through variance of a single security, consists both of, it's going to contain, that one stock will contain both systematic and unsystematic risk. So the systematic risk is not diversifiable. So it's a risk of the overall movement of the market. It's something that you can't, it's like the tide. When the tide comes in, all boats go up. When the tide comes out, all boats go down. So if you have a bear market, that's sort of a systematic risk that all stocks are going to face. If you have high inflation, interest rate volatility, global pandemics, these are things that are going to affect interest rate risk. Now, non-diversifiable is another term we have for systematic risk, or we might call it market risk. So these are three synonyms for the same term. Now, the unsystematic risk is diversifiable. So unsystematic risk is a risk of an event or a unique situation or asset for a smaller group of assets. So diversifiable, sometimes known as unsystematic or unique risk, would be something that could affect one company. So say, for example, one company or group of companies, restaurants, are asked to close to dine-in diners, to do takeout only. Or say that you have a particular industry that can be affected by an event. So maybe a tsunami or an earthquake can affect a business if they're located in one geographical area. If you have financial or business risk, financial risk would be a company's inability to pay its debts. Business risk would be a fundamental flaw or mistake the business makes. So you can see how these are really isolated to one company or a group of companies in a similar business. So if you get 10 or 15 different companies in different businesses in different locations, you can thereby stop this unsystematic risk. You can lower it. So this scale is a very famous scale where here we have, this would be the risk. So this would be risk measured by the standard deviation here. So this is our overall risk. This is our overall number of stocks. So this non-diversifiable risk here, the systematic risk, this market risk that all stocks will face, you can't reduce. So this is no matter how many stocks you have in your portfolio, this yellowish orange area here is never going to be declined by adding more stocks to your portfolio. However, this diversifiable risk, so if you had all your money in one company and that company, say, we can talk about Luckin Coffee, where the executives falsified revenues and profits and the stock drops 80% in one day. That would be an example of diversifiable risk. So instead of just owning that one company, you own 10 companies, you can get rid of quite a bit of that diversifiable risk. And when you get to about 20 or even 30 companies, you've squeezed out the majority of this diversifiable risk. So just by diversifying your portfolio, you'll lower this risk. And as you get to even more stocks, say like the S&P 500, you almost virtually diminish this diversifiable risk to a very low percentage. So that's why we want to have a number of securities in our portfolio to help reduce this diversifiable risk. So why have this diversifiable risk if you don't need it? Now, one thing that I want to talk about, this is part of Chapter 9, but it's important for your stock analysis papers, is the capital asset pricing model. So this is a model that we could use to calculate the required rate of return. This is most likely mentioned in the previous chapter. So this is an objective fact-based model. We're going to focus on the relationship between risk and expected returns for assets. So it's going to build off that Markowitz portfolio theory, and we're going to utilize the capital asset pricing model to give us the expected return that we would need to cover us for the risks associated with that particular asset. So the model, which is down here. So here's the model. We're going to get back to this later. But first, before we talk about that model, how that mathematics of that model work, we want to talk about the beta. I want to explain beta a little bit more. So beta, or beta coefficient, is something I talked about in Chapter 7. I also showed you a couple of mathematical models with that as far as calculating beta for a portfolio and calculating the return of a stock utilizing beta. So we know from last chapter that beta is the measure of the correlation between a stock, or you can say an asset, compared to the market it's in. So if you want to build a well-diversified portfolio, you want to look at the relationship of these betas within the stocks of that portfolio. So it's going to measure the non-diversifiable risk. That's what's great about the beta. It measures a stock's non-diversifiable risk. And how we do this is we plot a graph, and we find the slope of the asset's return in relationship to the market return. So the more greater that slope is, the higher the beta. And this is going to measure the sensitivity between the asset and the market. So we want to, of course, higher betas, larger betas will have more risk. Now, the characteristics. So remember from when we talked about correlation coefficients last chapter, beta measures how the reaction between the individual stock's returns or volatility is related to a market. So beta greater than 1 would show that its reaction is stronger than the market. So the market moved up 10%, a beta of 2, the stock would move up 20%. So a beta between 0 and 1 means that it's less reactive to the market. So if a beta of 0.5, if the stock market went up 10%, this stock with a beta of 0.5 would only go up 5%. Now, if you have betas that are less than 0, like a negative beta, the market's going to move in opposition. The stock's going to move in opposition to the market. So if you had the beta of -1, the stock moved up 10%, the market moved up 10%, this stock would go down 10%. So there's an inverse relationship when you have a negative beta. So the beta of the overall market is 1. So then greater than 1 for a stock, a beta of a stock greater than 1 is going to have a bigger reaction to any market changes. But a beta that's smaller than 1, it will have a smaller reaction. And if the beta is negative, it will move in an inverse relationship to the market. So portfolio beta is a weighted average of the individual stocks betas. And this is something that we calculated in the Excel piece of Chapter 7. When I went through the Excel, I included a weighted beta of a portfolio. So now, why it's important to know beta, because it's a good measure of risk, and it's good to talk about when you're doing a stock analysis report as far as risk, and you can use this capital asset pricing model to calculate the required rate of return for the stock that you're analyzing. And you can do this for all stocks that are in your database. So for the project. So here is the formula. So RF is going to refer to risk-free, and risk-free is going to be what we would call, say, a 3-year treasury bill. And it means that there's no risk of default. So the risk premium is going to be using beta to amplify the expected return. But we want to, the expected return of the market. So this is return of the market, R to the M. So if the expected return of the market was 10 and the risk-free rate was 2, we want to subtract that risk-free rate so we only amplify the remaining market risk, which would be 8%. And we multiply that by the beta. So the beta was 2, that would be 16. If the overall market return was 10%, part of that has to include the risk-free rate, but we don't want to amplify the risk-free rate, only the market risk. So that way when we're calculating K, and K represents the required rate of return, we want to, first we're going to start inside the parentheses. We want to subtract away the risk-free rate so we don't amplify that. So the remaining risk will be just the market risk. Once we subtract away the risk-free rate, then it's multiplied by beta to amplify that market risk. Then we add back that unamplified risk-free rate to calculate the required rate of return. So the greater the systematic risk as measured by beta, the greater the required rate of return as symbolized here by K. So this is the model that you could use to calculate what the required rate of return for a stock is. So if you have an estimated return on what the stock is likely to produce in the market, or your forecast is showing the stock is currently at $35 and you expect it to go to $50 per share, you can calculate your the percentage you expect the stock price to go up. And if the stock price is going up more than the required return calculated by the capital asset pricing model, then you could say the stock would be a good purchase, would be undervalued. So that's how you use the capital asset pricing model to help in valuing your stock in the stock analysis report. Okay, so those are the important aspects from Chapter 8, a couple little tidbits from Chapter 9 that can be useful and something needed to know for the stock analysis paper. And you can go ahead and read Chapter 8, of course, and you also could read Chapter 9 if you want a little bit more in-depth information about the capital asset pricing model and beta. Okay, thank you for your time, and I'll talk to you next time. Take care.